Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Rivian Automotive Inc. annual report. Rivian Automotive, a leading electric vehicle manufacturer, offers a diverse range of businesses and services that cater to both consumers and commercial clients. The company's product lineup includes the R1T pickup truck and the R1S sport utility vehicle, designed for personal use. In addition to its consumer vehicles, Rivian provides various software and services, such as remarketing, vehicle repair and maintenance services, and vehicle electrical architecture and software development services. This comprehensive approach enables customers to manage their vehicles efficiently throughout their lifespan. Rivian also focuses on infrastructure development by designing, developing, manufacturing, and operating the Rivian Adventure Network direct current fast chargers. The company offers access to combined charging standard, ensuring seamless charging experiences for its customers. Furthermore, Rivian has developed FleetOS, a proprietary fleet management platform that provides end-to-end centralized management solutions for commercial clients. This innovative platform enables businesses to optimize their fleet operations and reduce costs. The company's commitment to electric delivery vans is evident through its collaboration with Amazon.com, Inc., resulting in the Rivian commercial van platform. By offering direct sales to customers in both consumer and commercial markets, Rivian has established itself as a prominent player in the electric vehicle industry. Rivian Automotive Inc. has experienced a significant surge in its stock price over the past year. One major factor contributing to this growth is the increasing demand for electric vehicles, EVs. As governments worldwide implement stricter emissions regulations and consumers become more environmentally conscious, Rivian's focus on sustainable transportation has resonated with investors. Rivian's partnership with Amazon has also played a crucial role in its stock price increase. The e-commerce giant has ordered 100,000 R1T electric pickup trucks, providing Rivian with a significant revenue stream and validation of its technology. This collaboration has not only boosted investor confidence, but also demonstrated the company's ability to execute large-scale orders. In addition to these factors, Rivian's innovative products have garnered attention from consumers and investors alike. The R1T and R1S electric vehicles have received widespread acclaim for their performance, design, and features, solidifying Rivian's position as a leader in the EV market. As more consumers opt for eco-friendly transportation options, Rivian is poised to capitalize on this trend. Furthermore, Rivian's commitment to expanding its production capacity has alleviated concerns about supply chain constraints. The company's plans to establish multiple manufacturing facilities will enable it to meet growing demand and maintain a competitive edge in the market. This strategic move has reassured investors that Rivian is well-positioned for long-term growth. Overall, the combination of increasing demand for EVs, strategic partnerships, innovative products, and expanded production capacity have contributed to Rivian Automotive, Inc.'s stock price increase over the past year. As the company continues to execute its vision for sustainable transportation, it is likely that investor enthusiasm will persist. Rivian Automotive, Inc., market capitalization of $22 billion, is materially smaller than most of its industry peers of roughly $58 billion. Rivian Automotive, Inc. trades at a higher price-to-book ratio of 4.28 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Rivian Automotive's revenue growth and decline. The primary drivers of revenue growth for Rivian Automotive include sales transactions, customer deposits, and joint ventures with major players like Volkswagen Group. The company has also benefited from government loans, including a $3.355 billion loan from the Department of Energy. Additionally, the development of new facilities such as Stanton Springs North facility is contributing to revenue growth. On the other hand, several factors are driving revenue decline for Rivian Automotive. A decrease in deliveries of vehicles and the expiration of tax credits after September 30, 2025, are major contributors to this trend. Furthermore, a shift in consumer preferences towards higher performance variants has led to an increase in average selling prices, resulting in lower sales volumes. The company's revenue growth is expected to slow down in 2025 compared to 2024, with projected revenues of $3,830 million, down from $4,486 million. However, software and services revenue is expected to see significant growth, increasing from $484 million in 2024 to $1,557 million in 2025. Overall, Rivian Automotive's revenue growth and decline drivers are closely tied to its sales transactions, joint ventures, government loans, and facility development. The net income of the company experienced a decline from -$5.432 billion in 2023 to -$4.747 billion in 2024, and further decreased to -$3.646 billion in 2025. This decrease was attributed to various factors, including increased production costs, reduced governmental incentives for EVs, and manufacturing shutdowns. The profit margins also underwent a significant change during this period. Initially, the company reported a gross loss of -$2.03 billion in 2023, which improved to a gain of $144 million in 2025. The operating expenses as a percentage of total revenues increased from an unknown value in 2023 to 83.6% in 2024, before decreasing to 68.7% in 2025. The reasons behind these changes were multifaceted and complex. The company continued to invest heavily in its business, building capacity and ramping up operations, which contributed to the decline in net income. Additionally, uncertainty around achieving or maintaining profitability due to factors such as demand, cost increases, and government incentives also played a role. Furthermore, the reversal of previous administration's policy, directives on clean energy and EVs, efforts to scale back emissions regulations, and reduced governmental incentives for EVs all had an impact on the company's financial performance. The financial health of a company can be gauged by its ability to generate positive operating cash flow. However, the current situation for this particular company reveals a concerning trend. According to the summary, the company is generating negative operating cash flow. This indicates that the company's expenses are exceeding its revenues, resulting in a net outflow of cash from its core operations. As a result, the company may struggle to meet its financial obligations and invest in growth initiatives. The negative operating cash flow can have far-reaching consequences, including reduced liquidity, increased debt levels, and decreased competitiveness. In conclusion, the company's inability to generate positive operating cash flow is a significant concern that warrants attention from management and investors alike. Addressing this issue will be crucial for the company's long-term sustainability and success. The company's debt level has remained relatively stable over the past 2 years, with a slight increase in long-term debt from $4.44 billion in 2024 to $4.4 billion in 2025. However, there are indications that this stability may change in the future, as the total principal amount of secured debt is expected to increase significantly upon accessing funds under the DOE loan. In terms of interest expenses, there has been a significant fluctuation over the past 3 years. In 2023, the company reported an interest expense of -$220 million, which increased by 45% to -$318 million in 2024. However, this trend was reversed in 2025, with a decrease of 14% from 2024 to -$274 million. The increase in interest expenses is attributed to changes in interest rates on certain debt instruments, such as the 2031 secured notes, which saw an interest rate change from 0% to 10.6%. Despite this, the company's cash paid for interest decreased from $279 million in 2024 to $222 million in 2025. The performance of various regions and segments has been analyzed based on the extracted summaries. On a positive note, several areas have shown strong results. In North America, specifically in the United States, there was significant growth. Canada also performed well, as did Europe. Additionally, California demonstrated impressive performance. On the other hand, some regions and segments struggled to keep pace. International markets faced challenges, hindering overall progress. The Normal IL area experienced difficulties, while the Stanton Springs North facility, a potential future location, is expected to face workforce-related issues. Rivian Automotive's outlook and strategy are centered around revenue growth, cost reduction, and investments in future technologies and operations. The company expects its revenue to increase from 2023 to 2025, with gross profit improving significantly by 2025. To achieve this, management aims to control costs and realize economies of scale. Rivian is also investing heavily in future vehicle platforms, new in-vehicle technologies, and go-to-market operations. The company has established a joint venture with Volkswagen Group to bring next-generation electrical architecture and software technology to their future electric vehicles. This partnership is expected to drive growth and innovation for the company. In terms of financing, Rivian has secured funding through loans and convertible notes, indicating a focus on growth and expansion. However, management also acknowledges the current global economic uncertainty, which presents significant risks to the company's outlook. Despite these challenges, Rivian remains committed to its growth initiatives, including creating 75 new jobs at the Stanton Springs North facility by December 31, 2047. Overall, Rivian Automotive is positioning itself for long-term success through strategic investments and partnerships. While there are potential areas of concern or uncertainty, management's focus on growth and innovation suggests a positive outlook for the company. The company has made it clear that it will not be paying dividends to its shareholders for the foreseeable future. This decision is reflected in multiple sections of the provided information, including a direct statement on page 48 and an absence of dividend payments on capital stock, as mentioned on page 55. Furthermore, while interest on convertible notes has been paid, no dividend payments or distributions have been made on capital stock, as stated on page 100. In terms of share buybacks, there is no mention of the company purchasing back its own shares from the market. This suggests that any excess funds may be retained by the company for future growth and development, rather than being returned to shareholders through a share repurchase program. Concerns about inventory buildup and supply chain disruption. The company faces significant challenges in its supply chain management. One of the primary concerns is inventory buildup, which can lead to lower sales, revenue shortfalls, loss of customers, and increased inventory levels. This risk is evident from the decrease in total inventory from $2,248 billion in 2024 to $1,594 billion in 2025. Supply chain disruptions are another major concern for the company. Delays in manufacture and delivery of vehicles due to vendor relationships and supplier constraints have already been experienced. Tariffs imposed by the U.S. government have increased production costs, while retaliatory tariffs and trade barriers may continue to do so. The potential for supply chain disruptions is further exacerbated by factors such as raw material and component price fluctuations, disruptions in supply of raw materials, components, and equipment, and renegotiation with suppliers. The company's ability to efficiently obtain raw materials and components from suppliers is crucial to its production levels. However, uncertainty in lead times due to supplier contracts and market availability poses a significant risk. Furthermore, trade tariffs or other trade barriers may disrupt the supply of raw materials and components, while changes in export control requirements have already impacted the company's ability to receive these essential materials. In conclusion, the company faces substantial concerns about inventory buildup and supply chain disruption. These risks are multifaceted and can be triggered by various factors, including tariffs, trade barriers, supplier constraints, and market fluctuations. Addressing these challenges is crucial for the company's continued success and growth. That concludes the financial summary for Rivian Automotive Inc. Feel free to comment below, and I will be happy to answer them when possible.